They told them it was the dream. A front door with their own key. A quiet street. A small garden. A kitchen filled with morning light. A place where their future children could grow up. For Daniel and Emily, buying a home did not feel like a financial decision. It felt like becoming adults. They had spent years renting apartments with thin walls, rising rent, and neighbors they never knew. Every month, they watched money leave their bank account and disappear forever. So when people said, renting is throwing money away, it made sense. A mortgage sounded different. A mortgage sounded responsible. A mortgage sounded mature. A mortgage sounded like the first step toward wealth. Pause. The real estate agent smiled when she opened the door to the house. Warm tone. This one won't last long. The living room was smaller than the photos, but Emily loved the windows. Daniel walked through the hallway imagining framed family pictures on the wall. There was a backyard just big enough for a barbecue. The neighborhood looked safe. The schools looked decent. The house smelled like fresh paint and possibility. Pause. And then came the sentence that changed everything. You deserve this. Pause. That was all it took. Because the most powerful financial products are never sold as financial products. They are sold as identity. This was not just a house. This was proof they had made it. Proof that the years of working, saving, sacrificing, and saying no to small pleasures had finally become something real. But behind the front door, behind the staged furniture, behind the smiling agent and the congratulations, there was another story. A colder story. A story written in interest rates, closing costs, property taxes, insurance, repairs, fees, and 30 years of payments. Because the dream home was not only a home, it was a contract, a machine, a complex financial instrument designed so that everyone got paid before they truly owned anything. And by the time Daniel and Emily understood that, they were already holding the keys. Before we go deeper, if this kind of financial storytelling helps you see money differently, subscribe to the channel. And tell me in the comments, do you believe a mortgage is freedom or just debt with better marketing? The first emotion was not fear. It was excitement. When the bank approved Daniel and Emily for the mortgage, they did not feel trapped. They felt chosen. Approved. That word does something strange to people. It sounds like permission. It sounds like validation. It sounds like someone important looked at their lives, their income, their credit history, their discipline, and said, "Yes, you are worthy." They were approved for more than they expected. The number was shocking. For a moment, Daniel felt rich. Not because he had more money, not because his income had changed, not because his savings had grown, but because a bank was willing to lend him hundreds of thousands of dollars. And that is where the illusion begins. Many people mistake borrowing power for wealth. They see the approval amount and think, this is what I can afford. But affordability is not the same as approval. A bank does not approve you based on what will make your life peaceful. A bank approves you based on what it believes you can survive paying. there is a difference. A huge difference. The bank does not ask, will this payment allow you to sleep at night? It asks, can we collect from you every month? Daniel and Emily sat across from the mortgage officer while numbers moved across the screen. Principal, interest, escrow, taxes, insurance, PMI, closing costs. The words sounded technical enough to feel normal, and normal enough to feel safe. The monthly payment looked high, but possible. Tight, but possible. Uncomfortable, but possible. And in modern life, that is often all people need to hear. Not wise, not freeing, not low risk, just possible. Possible is how people sign away decades. Emily asked the question most buyers ask. So after 30 years, we own it? The mortgage officer nodded. Yes. But that answer was incomplete. Because after 30 years, if everything goes right, they might own the house. But over those 30 years, they would pay far more than the price on the listing. They would pay the seller. They would pay the bank. They would pay the county. They would pay the insurance company. They would pay inspectors, appraisers, brokers, contractors, plumbers, roofers, and anyone else standing near the transaction. The first few months felt beautiful. Daniel mowed the lawn every Saturday morning. Emily bought curtains. They hosted dinner for friends and proudly said the words, "Our house." It felt different from renting. The walls were theirs. The floors were theirs. The scratches, the paint, the tiny imperfections, all theirs. But then, the house started speaking in bills. First, the water heater began making a strange sound. Then the property tax estimate changed. Then the insurance premium increased. Then the kitchen faucet leaked. Then the air conditioner struggled during a heat wave. Every problem came with a price tag. At first, Daniel told himself, this is normal. Houses need maintenance.
In your finances.
And he was right.
But soon, you're just watching
the problem was not that houses need maintenance. The problem was that nobody had explained what ownership actually feels like when the house owns your cash flow. Rent is the maximum you pay. A mortgage is the minimum. When you rent, vacation? Postpone it. Emergency fund? Rebuild it later. Investing? Maybe next year. Dinner out? Not this month. New car tires? Use the credit card. A weekend away? Too risky. Their house was appreciating on paper, but their life was shrinking in reality. This is the part of the homeownership dream people rarely talk about. You can be building equity and still feel broke. You can have a rising home value and still have no liquidity. You can live in an asset and still be financially fragile. Because equity does not buy groceries unless you borrow against it. Equity does not fix your car unless you turn it into more debt. Equity does not make you free if accessing it requires another loan, another application, another interest rate. Daniel and Emily were not poor, but they were trapped in a strange middle place. Too successful to complain, too stretched to breathe. And every month, the bank received its payment first, before investments, before dreams, before freedom.
One night, Daniel opened the mortgage statement. Not because something was wrong, just curiosity. He wanted to see how much progress they had made. They had been paying for almost a year. 12 payments, 12 months of discipline, 12 months of sacrifice. But when he looked at the principal balance, he froze. It had barely moved. Most of the money had gone to interest. The bank had collected month after month, but the debt still looked enormous. Daniel stared at the screen. How is this possible? This is where the mortgage reveals its true shape. At the beginning of a traditional mortgage, the payment is heavily weighted toward interest. The bank gets paid early. The borrower builds ownership slowly, very slowly. The first years are not designed to make you feel rich. They are designed to make the loan profitable. That does not mean the bank is evil. It means the bank is a bank. Its job is not to give you a dream. Its job is to price risk, collect interest, and generate return. But the marketing does not sound like that. The marketing says home, family, roots, stability, legacy. The contract says interest. Daniel began calculating. If they stayed for 5 years and sold, how much would they actually keep after agent commissions, closing costs, repairs, taxes, and moving expenses? If the house... Leverage makes good outcomes bigger, but it also makes bad timing more dangerous. A rising market can make homeowners feel brilliant. A falling market can make them feel trapped. A stable market can still leave them cash poor if the monthly burden is too high. Emily walked into the room and saw his face. What happened? Daniel turned the laptop toward her. We don't own the house. She looked confused. We bought it. Daniel shook his head. No. We bought the right to keep paying for it. That sentence changed the room. Because it was not dramatic. It was accurate. They had confused possession with ownership. They had confused a mortgage approval with wealth. They had confused the emotional comfort of having a home with the financial reality of carrying debt. And this is the quiet danger. Most people do not lose money on homes because they are stupid. They lose flexibility because they buy too much house too early. They underestimate the hidden costs. They overestimate appreciation. They forget that life changes faster than a 30-year contract. A mortgage can be a path to wealth, but only if the house serves your life. Not if your life becomes a servant to the house.
So what should Daniel and Emily have done? And what should anyone do before buying a home? The answer is not never buy. That is too simple. Homeownership can be powerful. It can create stability. It can protect you from rent inflation. It can build equity over time. It can become part of a strong financial foundation. But only when it is purchased with clear eyes. Not emotion, not pressure, not fear of missing out, not because someone said, renting is throwing money away. Because buying the wrong house is also throwing money away, just more slowly. The first rule is this. Do not ask, can I afford the payment? Ask, can I afford the life that comes with this payment? That means the mortgage should not consume your future. You still need room to invest, room to save, room for emergencies, room for repairs, room for career changes, room for having a child, losing a job, getting sick, helping family, or simply being human. A home should not require a perfect life to survive. If everything must go perfectly for you to make the payment, the house is too expensive. Because life does not go perfectly for 30 years. The second rule, never trust the monthly payment alone. Look at the full cost of ownership. Mortgage, interest, taxes, insurance, maintenance, repairs, utilities, HOA fees, transaction costs, opportunity cost. Ask what the house will take from your cash flow every year, not just every month. Because the danger is not always one big disaster. Sometimes it is 1,000 small leaks.
The third rule, buy time, not status. The best home is not always the biggest home you can qualify for. It is the home that lets you sleep, the home that lets you invest, the home that lets you say no to a bad job, the home that does not turn every emergency into panic. Daniel and Emily could not undo the purchase overnight, but they could change their relationship with it. They built a real emergency fund. They stopped upgrading the house for appearances. They created a maintenance account. They paid attention to refinancing opportunities, but did not depend on them. They started investing again, even in small amounts. They stopped calling the house their only wealth plan. And most importantly, they stopped treating homeownership like proof of success. A house is a tool, not a trophy. When a house gives you stability, flexibility, and long-term ownership, it can be a blessing. But when a house drains your cash, limits your choices, and keeps you chained to work you hate, it is not freedom. It is decorated debt. So before you sign, slow down. Run the numbers. Ignore the emotional pressure. And remember, the bank is not asking whether your life will feel free. You have to ask that yourself. Slow down.
Daniel and Emily still live in the house, but they see it differently now. The walls are still warm. The kitchen still catches morning light. The backyard still holds laughter on quiet weekends. The dream was not fake, but it was incomplete. Because a home can be emotional and financial at the same time. It can be shelter and leverage, comfort and risk, stability and obligation, an asset and a liability. The danger begins when we only tell one side of the story. Society tells people that homeowners are winners and renters are falling behind. But real wealth is not measured by whether your name is on a deed. Real wealth is measured by freedom. Can you breathe? Can you save? Can you invest? Can you handle a bad month? Can you leave a job that is destroying you? Can you live without every paycheck already being claimed before it arrives? If the answer is no,
then the house may look like wealth from the outside, but feel like a life sentence on the inside. This is the homeownership myth. Not that buying a home is bad, but that buying a home automatically makes you wealthy. It does not. A mortgage is not magic. A deed is not freedom. A higher home value
Is not the same as a better life. A home becomes wealth only when it supports the rest of your financial life, not when it consumes it. So the real question is not should you buy or rent. The real question is, will this decision make you more free or just more approved? Because approval is not ownership. A mortgage is not success. And a dream home is only a dream if you are still allowed to have a life inside it. If this video made you think differently about mortgages, homeownership, or the meaning of wealth, hit the like button so more people can see the side of the story most people never hear. Subscribe for more financial stories that reveal how money really works behind the dream. And comment below, is buying a house still the American dream? Or has it become the most expensive trap people are proud to enter? Thanks for watching. And remember, the goal is not to look wealthy. The goal is to become free.